How do you find trend reversals and trend exhaustions? So if you're a trader who trades ICT, SMC, or regular price action concepts, maybe even indicators, and you're looking for the one thing that could set you apart, give you greater confirmations on when to enter a trade, and also when to exit a trade using higher time frame and lower time frame confirmation, this video is going to be for you, right? So as always, when we come into the markets, we always want to start with the higher time frame. So in this particular trading scenario, this is the S&P 500 on the 4-hour. So how do I use the 4-hour time frame? Well, it's pretty simple, right? I always start off with what I call the 4-pillar approach, and I've been through this several times in several videos. So what we are looking for essentially is we're looking for structure highs, structure lows, and structure highs. So you can see here in red, I have clearly marked out how I look at the structure and how I form the structure, right? Quick note about the structure, it doesn't have to match me exactly, but what you want to understand is that we are generally in an uptrend based on our structure. Now, if we go to the daily time frame and see why this is important, right? We can see on the daily time frame we have a fair value gap over here, and so this is going to be the point of interest or the POI or the supply area, whatever you want to call it. And so the main important thing to understand is that we have a bullish bias overall on the S&P 500. So notice how we don't have any local fair value gaps down here. The only fair value gap to fill is here, corresponding to this fair value gap over here. Now, with that being said, if we go down to the 4-hour and we go to Wednesday of last week, Wednesday the 11th of June, what's actually going on here is though we have a bullish structure, right, we're seeing somewhat of a correction or a pullback. And so the main topic of this video is how can you determine when you're going to get the change in trend or you're going to get an exhaustion in the uptrend, right? So this is important to understand. Let's break this down from a very, very basic kind of SMC or smart money concepts perspective. So we can see here we have the previous high. So I'm just going to mark this out. So we have the previous high like this, and the market has engineered a significant amount of sell-side liquidity, be it in the form of a trend line over here, right? So now that we're above an old high, right, we know from our basic understanding of market structure, right, where are you in the markets, right? So what this means, if you break it down very simply, and though it's a simple concept I want to go over, right, the market moves up, then we have a pullback. Then the market moves up, we have a pullback. The market moves up, we have a pullback, and the market moves up. And so you want to ask yourself, why is the 4-hour structure bullish? The reason it's bullish is because we're targeting this daily fair value gap or this daily supply area above. Now, with that being said, you need to understand a couple of things, right? When price breaks above an old high, we tend to have a pullback. When price breaks above an old high, we're above an old high like this, we have a pullback. And then from here, we have a pullback. So we're in this position now in the markets where price has actually broken. So we're now above an old high. We're in this region, right? So this gives you higher time frame context to look for a trend reversal without even using fair value gaps, without even using order flow or any of the other concepts we're going into. If you can understand where you are on the higher time frames, it's pretty simple to get on the right side of the market, right? So a lot of it comes down to using the higher time frame and using the basic concepts, right? Using the basic principles. Now, with that being said, if we go down to the 15-minute time frame, on the 15-minute time frame, we can see a couple of things, right? So let's take a look at what's going on. Now, on the 15-minute time frame, I'm typically looking at a few different things, and let's kind of zoom into this price action over here. First, what I want to see is I want to see previous day liquidity being swept. Now, this is so important. Every day when you go onto your charts, you want to mark out the previous day high, right? Previous day high, and I'm going to put this in red. I'm going to change it to a different color. So this is the previous day high, and we can see the market has swept this area, right? Pretty aggressively as well, right? We see the market sweeping this area. Now, this is what you can refer to as the high of the day or the ICT Judas swing or the manipulation, right? It's simply an area where the market has aggressively went towards, right? It is a liquidity sweep, right? So what makes a high probability liquidity sweep is what happens around that liquidity sweep. So notice how we've taken out the Asian high, we've taken out the previous day high, and we've also left a fair value gap over here. So if we take a look at this, right, when price leaves a fair value gap, this means that this is going to be our point of interest, right? This is what makes a point of interest or a supply area valid. So I get a lot of questions about how I form a POI or a supply area. And so the way that I do that is by looking at the behavior around the POI, looking at the behavior around the price action. So one thing I want to see, or three things I want to see when it comes to a POI. The first is I want to see some kind of a break of structure or a market structure shift, right? And we see that kind of down here, right? We see some kind of shift in the market structure. So I'm going to label that in black. You want to see the market breaking some kind of structure, whether it be a high or a low. usually it's just going to be a high or a low, right? So you want to see a market structure shift. The next thing you want to see is you want to see a sweep of liquidity, right? So what do I mean by a sweep of liquidity? Typically it's Asia, but my favorite liquidity sweeps are those previous day highs and lows, right? So if you trade the S&P 500 in the New York session, or you trade the Nasdaq, NQ, even the Forex markets, right? London and particularly New York session during the news events are more likely to give you those liquidity sweeps. So based off the economic calendar, right, if we go back to last week, right, what we had over here was 9th, 13th. If you take a look at what was going on, we had a huge amount of news from Wednesday, Thursday, and Fridays, particularly Wednesday the 11th, 1:30 p.m. UK time, so this corresponds to 8:30 a.m. EST or New York time. We can see we had core CPI, we had CPI data come out, right? So that is the reason we had this liquidity sweep over here. So one pro tip, when you're looking for your POIs or your supply areas, you want to make sure you're trading in line with the news events, in line with liquidity. And what that basically means, simply put, is you want to wait for news events and you want to see how those news events sweep liquidity. That's the simplest way I can put it for you. Market structure shift, liquidity sweep, right? The next thing we're looking for, of course, is a fair value gap, right? We want to see price leaving a fair value gap, right? The market gravitates towards fair value gaps. It's the most important thing. And so from here, to go back to our previous question about a trend reversal, right, or a trend absorption, what is going on inside of this POI? This is important to understand. But one other thing I want to give traders as a confluence, right? Look at the power of three over here. So this is what we call this is the power of three, daily power of three, right? Just to give you, in terms of how I find this indicator, so if you just type in PO3 and the indicators, you want to use PO3 by 2 degrees, right? So 2 degrees spelled T-O-O, right? You want to use this one, power of 3 by 2 degrees. So what's happening here is you want to understand that this POI is above the daily opening. So this is the daily opening, and you can see the market has given the high of the day, and the high of the day is that liquidity sweep over here, right? This liquidity sweep liquidity sweep is responsible for the high of the day, right? It sweeps liquidity and it leaves a fair value gap. These are the areas we want to be trading from, hence why we call it a POI. It is a point of interest, a supply area, whatever you want to call it. It's somewhere where you want to be trading from. And notice how the price action leaves a wick. And this is what's important to understand. If there's one thing you take away from this video, is that you want to understand the best traders in the London or the New York session, especially the New York session, can position themselves correctly inside of a wick. And so what that means is you want to be entering inside of a wick. So that means you want to be selling high above the daily opening price, and vice versa, buying low, because this is how a daily candle forms. So if you take a look at the way the daily candle forms, we can see that the market actually moves higher to sweep liquidity, and then we see the market moving lower. And so our job is to understand what's going on inside of the wick, right? Now, if we continue to play price on going into the next day, one question I often get now is, what happens if the market doesn't tap into the POI in that same day? Well, that's perfectly fine. We just use that same POI for the next day. So when I come to a chart and I do my pre-market analysis, this is typically what I'm looking for, right? I want to see the market sweeping liquidity, leaving a fair value gap, and also there's liquidity to target when price gets back into that zone. And so this is what I mean by that specifically. So again, we're using the same principles, but for the next day. So if we just take a look at this, what we can see now is we can see Thursday, the 12th of June, the following day. So again, we have our trusted tool over here. So this is now the daily opening price. This is the daily candle. Again, PO3 by 2 degrees, just search it up, the best tool you can use. This is the daily opening price, this red line over here. So when price comes into this POI over here, we can see the price, we tap in at around 10:30 a.m. Eastern or 3:30 p.m. UK time. So now we've come into this POI. What am I thinking, right? What's going through my head, right? How can we determine the trend exhaustion or the trend reversal from here, right? So the short answer is you want to be using order flow, right? But the slightly longer answer is that every single trend will reverse when you use the 3 following steps, right? You want to have a key level, right? And we're going to talk about quickly what defines a key level. You want to see price enter the key level, right? So you're looking for an entry, and I also write PO3 entry. So entry plus PO3, then the last thing we look for is the order flow. And so the order flow is the defining piece as to the fact that the trend is going to reverse, and we could see a reversal lower. Now, just want to go over a few things, right? How do you correctly find the right fair value gap? And so I'm going to just give traders a little bit of a nugget here, just so you can understand. So a lot of traders will look at this fair value gap and go, right, If you take a look at this London fair value gap, a lot of traders will try and trade from here, right? They'll try and trade from here, and technically it does tick all the boxes. It leaves a fair value gap, prices above the daily opening, but there's a few problems with this. Now, the first problem is naturally there's a POI all the way up here. So you want to have a more open mind when it comes to your key levels, and you want to try and ask yourself, what has the previous day actually done? And this is where we use the economic calendar. So the economic calendar is going to be our best friend for this, right? If Wednesday had the first day of manipulative news, right? CPI, PPI, whatever it may be, you want to keep an eye on the fair value gaps near those liquidity sweeps, right? That's kind of ICT concepts, SMC, whatever you want to call it. You need to keep an eye out on the POIs, right? So that's one reason I personally wouldn't be trading off this POI. The second reason, and this is the main reason, if you take a look at here closely, we have the Asian high and we also have the London high. Now they've created equal highs. When you see equal highs as a very, very basic trader, whether you're ICT, SMC, it doesn't really matter. When you see Asia and London giving equal highs like this, that will invalidate the POI. So you do not want to be trading near equal highs, right? Because you can obviously see that the result of that wasn't very good, right? The market did blow through that. And so the best way to kind of avoid these losses is to understand liquidity, right? Liquidity is super important. So you do not want to be trading, buying or selling near equal highs and lows, right? Now, when it comes to a trend reversal, right, as price is moving higher, what gives you the confidence to sell from this particular area? So we can see a very strong mitigation into the area. And this is where effectively we use key level, entry, and now we're on the entry in PO3, right? So we have a key level, tick, 15-minute fair value gap. It ticks all the boxes we went through earlier, right? Sweep of liquidity, break of structure, fair value gap, etc., etc. It's ticked all the original boxes. And so when we continue to look at this, right, what we can see from a daily opening, from just a daily PO3 perspective, is that we are way above the daily's opening price, right? We're all the way up here, right? The day opened down here. So if I play this on before we go to order flow, what you want to understand is this, right? The market will do something like this, right? The market will do something in this kind of way, right? So before the market moves down, it's going to move down above the daily opening price. And so the best way you can catch this is you want to understand that the best traders position themselves inside of a wick, right? This is the daily opening price. The best traders are not going to enter here. They're going to try to enter as high as they can inside of the wick. And so the best traders can position themselves inside of a wick. If there's one thing you take away from this video, it is that one phrase, right? The best traders can position themselves correctly inside of a wick. And so now we come on to our confirmation. What is the confirmation you can use, right? How could you have taken a potential scalp over here, right? So there were multiple trades from this area. You may not have got all of them, but you want to catch some of them, right? So if we just kind of replay price. Now we're on the third and final stage, which is basically the order flow. And so this is the common misconception I see, right? Trend absorptions or trend exhaustions come from literally, in this case, buyers being exhausted, right? So what you're looking for is buyers to be exhausted. And so what does that mean, if I can spell, right? What does buyer exhaustion actually mean? What does it mean for the buyers to be exhausted? So you want to see a huge amount of aggressive buyers over here, right? A large amount of aggressive buyers. And you want to see price kind of giving you the buyers over here, and you want to see the market giving you the buyers over here. And so if we just play price on a little bit, what we're looking for is we're looking for buyers to fail. When they're exhausted, it means they've failed, right? So buyers have failed. Right, so what this means is that we see a large ask volume, right? So this is where we're now going to, if I can spell today, we're going to be going over the footprint charts. And so this is how we determine if a trend is going to end, right? This is how we determine that. So if we just get our charts in front of us. So what was going on is so on that day, I'm saying ES, these are the two main levels I'm looking for. We have a level down here, and we have a level up here. And trading is really that simple. If you're looking for trend reversals, you're looking for a key level, you're looking for an entry in the key level validated with the power of 3, and then you are basing everything off order flow. It's that simple. It's really that simple. It's not actually complicated. So we have a 10 a.m. Eastern candle over here. So this is now the 10 a.m. power of 3, right? The 10 a.m. candle opened over here. So you want to be selling above the candle's opening, right? Daily and ideally the 4-hour candle's opening price. If you can position yourself for a sell above a candle's opening, you can be slightly sloppy with your entries and still catch most of the move, right? Pro tip. So now we're just waiting for price to come in. And notice how trading, most of it is just being patient, right? Most of trading is just being patient and it's waiting for the level to be hit. That's all you're doing. So if we just go ahead and take a look what's going on, this is now where we use order flow to our advantage. So we can see the level is all the way up here, this big blue box, and we can see a lot of heavy aggressive buyers coming into the zone, right? Important to understand that. Now let's understand what was going on, and we're going to break this down quite logically in terms of the buyers and the sellers. So for those who are asking about trend reversals or spotting a trend ending, this is how you do it. So buyers have to be exhausted. And so what do I mean by buyers being exhausted? It's not that difficult. It's not difficult to read order flow or footprint charts. What you need to understand is that the market will enter the fair value gap and we're going to see a huge amount of aggressive buyers. So if we take a look at the left number, right? The left number represents the bid and the right number represents the ask. And so what we're seeing is the bid and the ask data. So why is that important? So a trend obviously is determined by the activity of buyers and sellers. That makes sense, right? The reason why is because when you trade, there's only one or two buttons you can press. It's the buy or the sell button. So knowing who's in control between the buyers and the sellers is pretty useful if you want to determine the end of a trend, right? As they say, a trend is your friend until it ends, and this is how you find if it's going to end, right? So what we're looking for is we want to see a significant buying of volume, right? Because we want to see buyers exhausted, and I'm going to explain what that means. So if you take a look, this is now the 5-minute candle. So this candle here represents 1, 2, 3, 4, these kind of 5 candles over here, this large drive into the area. Yes, we had 1, 2, 3 impulsive candles to the upside. And if we see what was going on, we see that they're backed by a huge number of aggressive buyers. In fact, let's make this a little bit bigger. If we make this a little bit bigger, we can see at the top, we see 10 for 337. So for those who are good at maths, that's roughly speaking a 33.7 times difference between the total number of aggressive buyers and sellers. Now, it's not just that number. If we take a look at the row underneath, we see 570 for 294. We see 426 for 796. That's roughly a 2-to-1. We see 360 for 856. So that's roughly a 2.2-to-1, whatever that ratio is. So what we can see is we can see 1, 2, 3, 4. We can see 5 delta outliers. And so a trend that's going to end basically means that buyers in this case are being exhausted. Now, if buyers are being exhausted, it means that there's a passive seller sitting at this area. And that's exactly what's going on over here. So when you see a large number of aggressive buyers coming into an area, right? If you see a large number of aggressive buyers and the buyers do not break above the fair value gap, so we can see the fair value gaps over here, we can see that these buyers have been very unsuccessful, right? A huge number of aggressive buyers have been unsuccessful. Now, a lot of people will say, oh, there's more buyers than sellers. Well, that's not completely correct, right? There's more aggressive buyers than sellers. So the way that we use footprint charts is you want to understand who is aggressive and who is being rewarded. Or in this case, more likely, who's not being rewarded. So the way you find a trend reversal or a trend exhaustion is to see which market participants are aggressive and not being rewarded. They are exhausted, and this is how you find an exhaustion of, in this case, a bullish upwards trend. And so what's going on is we see a shift in the delta from aggressive buyers down to aggressive sellers. Now notice how we come into this 5-minute fair value gap over here. And so if we just go back to the Discord where the screenshots are, what we're looking at now is we're looking for price to break this 5-minute fair value gap. And that's exactly what happened over here. So this was your first entry over here. As you can see, price went down to roughly 1 to 3. I closed just before this, so about 100 to 381. So that's about a 1 to 4. Or just under a 1 to 4, 1 to 3, 1 to 2, 1 to 3, 1 to 4, depending on how you managed it. But what's important to understand is that we can see over here aggressive sellers successfully broke the zone. So aggressive sellers broke the zone after, and this is the most important thing, after you saw this. So these buyers failed to break below the zone, above the zone. And that means that buyers have failed, buyers are exhausted, the bullish trend is over. And that's what gives you the confirmation to take shorts, right? That's what gives you the confirmation to take shorts like this down to the next fair value gap. So it's as simple as understanding who is in control between buyers and sellers. So if we go back to the regular candlestick charts, right? The reason the market moved down, right? On the even on the 15-minute time frame. The reason the market moved down is because buyers in this region failed to break above the level, right? So we saw a huge amount of aggressive buyers over here, and they failed. They failed to break above the level, because if they succeeded, right, if these buyers over here succeeded, right, if we just quickly go back to the footprint charts, because I like to have them up side by side. If we go to the regular footprint charts over here, all of these buyers over here, sorry, let me make that clear for people. All of the buyers that you saw resting over here would have won. None of them won, right? They failed to break above the level. That means the level is strong. That means you want to be selling from the level. And that means, for those who are asking, the trend reversed from this area. So the reason you saw a large drop last week was because the passive sellers were in control. And that's how you determine a trend reversal. So when we go back to the 4-hour, the way you can, if I make it clearer, the way you can determine a trend reversal like this, or to look for potential pullback, is by basically using and understanding what was going on over here. So this large drop last week came from the absorption of the aggressive sellers. And so if you like this video, give it a like, give it a thumbs up, and I look forward to seeing all of you in the next one.